If you're a beginner in the stock market, this video will permanently change how you invest for the better. Right now, you're staring down the path that 95% of investors take, and guess what? It leads nowhere. Today, I'm going to provide you with an alternative path. Don't make the mistakes that most beginners make. This video is the 5 biggest mistakes that beginner investors make when investing in the stock market. Now, all 5 of these are super important to avoid when beginning to invest. However, make sure you stick around to the end because the last one is vital if you want to beat the market over the long term. Just before we get started, if you're seeing my face for the first time and you enjoy the content, make sure you subscribe and hit that notification bell. You won't regret it. Number 1, caring too much about dividends. When I first started investing, I just looked for businesses that had really high dividend yields, that were paying out 8 to 10% dividends. And this is because I just assumed that, well, the dividend is a sure thing, whereas the stock price going up isn't a sure thing. So let's just invest in high dividend yield companies, and therefore I will be sure to make 8 to 10% every single year. However, younger me and many beginners misunderstand what the dividend yield actually represents. And in many cases, a high dividend yield is actually not a good thing. So we calculate the dividend by taking the dividend per share and dividing it by the current stock price. So what that basically means is the dividend can go unchanged, and it could just be that the high dividend yield is due to a low stock price or a stock price that has been falling recently. And if you just focus on the dividend yield, you may accidentally invest in some companies that are failing, which is causing their stock price to go down. If you are going to be looking into companies that pay a dividend, you need to make sure you're looking at the payout ratio too. The payout ratio is the dividend per share divided by earnings per share. And basically it tells us how much or what percentage of a company's earnings are being paid out to their shareholders. If a company has a payout ratio of more than 0.75, it means that they're paying out a huge proportion of their earnings to shareholders and not keeping a lot in the business for reinvestment and opportunity to grow. My advice would be not to look at dividends when you're just beginning. If you just invest in solid businesses, they're going to grow over the next 10 or 20 years. Then in 10 or 20 years, when the growth has slowed down, these great businesses will start to pay out a really healthy dividend for you. Number 2, buying new hot stocks. Now, this is a trap that many beginners fall into, where they think that they can see where the growth is coming from with only a basic understanding of the business. Don't overestimate your ability. Any obvious growth prospects in a business are already priced into the stock, which means there's no room for you to make a profit there. Let's just invest in companies that have 10 or more years of proven track record earnings power that we know will grow into the future over the next few years. Number 3, too many trades. Now, the biggest cost to a beginner investor is brokerage, the fee that you pay every time you make a trade. And new investors often make multiple trades every single month or every single week, which is far too many in my opinion. Think of it this way. If you invest $1,000 at a time and you're paying $10 brokerage, every time that you make a trade, you're losing 1%. So even if you got the market average of 10% over a year, if you made 10 trades that year, you've made 0 profit. Again, I would say that the best way to approach this is to buy stocks and hold them for many years into the future. Warren Buffett says that you should buy stocks as if the market will be closed for 10 years, as if you couldn't trade them for 10 years or more. And that is a great way to go after it because it means that you're only going to invest in businesses that you really believe will be much higher in the future. And it means that you're not going to be tempted to trade in and out of them in the daily or monthly market movements. Number 4, letting day-to-day stock fluctuations affect your emotions. In the beginning, it is fun to watch the stocks move in real time and see you make a little bit of profit over a few minutes. However, when you start to build a really substantial stock market portfolio, these day-to-day movements can really affect your mood. There's been times when my portfolio has dropped thousands in just a few weeks, and it really affected my mood and my ability to focus on anything else. So I just had to stop looking at it every single day, and now I only check my stocks every couple of days or even once a week. Just remember that the short-term noise in the market is absolutely meaningless. Nobody knows where the markets are going to go in the short term, and by short term I mean days, weeks, months, even a year or 2 years. No one really knows where a stock or where the market is going to go. So just buy stocks on discount and hold them for 5 to 10 years, give them a chance to grow and a chance for their stock price to accurately represent their value. And number 5, thinking that price equals value in the stock market. You have to think of price as disconnected from value if you want to beat the market consistently. Yes, there are many times when a stock's price or the market's price will represent its value. However, the market is essentially a pendulum that swings from optimism to pessimism and back to optimism constantly. And this happens on a day-to-day level in the day-to-day stock market fluctuations, but more interestingly, it happens over an economic cycle, which is usually 5 to 15 years. This means that when investors in general are overly optimistic about the outcome of the market, prices will be higher than their value. And vice versa, when the majority of investors are pessimistic about the market outlook, thinking that the market's going to go down, prices will be lower on average than value. When a stock's price goes up, holding its value constant, it actually becomes more risky because now it has to go even higher to make that profit for you. So I'm going to give you an example. Let's say that I own 10 shares and I bought them all at $100 per share, and it just so happens right now that the value of those shares is also $100 per share. So my net worth on paper is my 10 shares times by the stock price. So 10 times 100, which is 1,000. And my real net worth is my 10 shares times by the value of each share, which is also 100 right now. So that's 10 times 100, which is 1,000. Now let's say that the stock price drops to $50 per share. However, the value of that business is still $100 per share. Now my net worth on paper is my 10 shares times by $50 stock price, which is 500. However, my real net worth is still 1,000 because it's 10 times by the value of each share, which is 10 times 100, which is 1,000. In fact, now that the stock price is $50 and it's worth 100, I can now buy a dollar for 50 cents. For every extra stock that I buy at $50, my net worth goes up by 100 because I'm adding $100 of real value to my portfolio, even though I'm only spending $50. So that's it, guys. I hope you enjoyed this one, and if you did, make sure you leave a like and let me know your thoughts down in the comments below. If you're new around here, make sure you subscribe and join the team. But for now, I'll see you guys in the next one. See you later.